What is going on, guys? Nick here, back with another video. Michael Burry, or as every single article that I've read over the past week has made sure to point out, the big short investor who famously bet against the housing market in the late 2000s, memorialized by Christian Bale in the 2015 blockbuster hit, The Big Short. Michael Burry has a lot of predictions about the stock market, and his famous prediction has given him a lot of credibility. And honestly, after watching so many interviews and reading so many news articles about him over the past couple of weeks, he either comes across as somebody who is unbelievably smart or an absolute conspiratorial lunatic, and it's honestly hard to tell which. But either way, he's gotten a lot of attention recently about all of his tweets about the stock market decline that's coming up. So I started to wonder for myself, how good is Michael Burry at actually predicting the stock market? I mean, we know about the 2008 housing bubble prediction, but how many of his other predictions have actually come out to be fairly accurate since then? So I decided to find out, and I spent about the past week reading all kinds of news articles over the past 16 to 17 years about everything that Michael Burry's been saying. So in this video, I'm going to cover all of his major predictions that he's made, not every single one, but all of the major ones, and we'll take a look at how they turned out. Now, of course, I am going to start with the 2008 prediction, but if you don't feel like watching that, if you could just help me out by putting the video on mute, putting it 2x speed, turning the volume down, and waiting till it gets to this timestamp, that would really help me out with the audience retention. Otherwise, you can skip to the timestamp, but you at least owe me a thumbs up. At least. I did a lot of reading. So not too long after all the dust had settled from the 2008 and 2009 recession, Michael Burry wrote an op-ed in the New York Times called, "I Saw the Crisis Coming, Why Didn't the Fed?" In the article, he quoted Alan Greenspan saying, "No one could have predicted the housing bubble." Now keep in mind that this Alan Greenspan fellow was the chairman of the Federal Reserve from 1987 to 2006. From Ronald Reagan to George Bush, that George Bush. So Burry starts out his article talking about his research into the residential market and the mortgage-backed security market. What concerned him was banks were loosening the rules to make it easier to obtain mortgages. Banks were really interested in getting more and more mortgage signups, and an easy way to boost your mortgage signup numbers is to just make it easier, loosen some of the restrictions, make it for some of those people who don't have any credit or great finances to be able to get a mortgage. That's not going to work out too well. So Burry, and again, if you've seen the Christian Bale blockbuster, you already know this, Burry realized that prices were already very high for housing. Pretty much as high as they could go. By adding to the pool of buyers, by loosening the restrictions to sign up for these mortgages, it obviously increases demand. And demand increases without supply increases mean prices go up. But the problem is these subprime buyers mark the end of the customer pool that they could expand to. You're already selling to people who don't really have any money and don't really have any credit. Who can you sell a house to next after that? So without a way to continue to expand the market, the extreme demand couldn't be supported and the housing prices had to fall. So I don't really like to look at what people say in hindsight. It's just too easy to be right. So instead of reading the rest of this op-ed, I went to his 2006 letter to shareholders. Now keep in mind this was 2 years before the housing collapse happened, and while a lot of people say that he's the guy that predicted it, nobody else did, I actually found a report from Congress from 2007, which is about a year after the shareholder letter came out, but still before the housing market collapse, where they highlighted on the very first page, for the beginning period in the first quarter of 2007 and extended through the final quarter of 2009, if housing prices continue to decline, we estimate that subprime foreclosures alone will total approximately 2 million. So Burry knew, and clearly Congress had some idea, and now again, of course, this is public, so other people could have known. But here's what Burry said. Burry led off by saying that his short position would take time to pay off. Even in the event of a mispayment, it may take a year for these to appear in the form of a write-off, highlighting that the foreclosure process is very slow and the market's not going to collapse overnight. But what he pointed out was the deterioration was already pretty substantial. The vast majority of his portfolio was short Moody's low-quality rated subprime mortgages that were issued in just 2005, a year before writing this letter. This chart that he included shows the pretty substantial difference. He explained that this ratio that you're seeing is a ratio of the bad mortgages divided by the amount of credit support. Any ratio on this chart higher than a 1 is considered bad, and the mortgages on the left reported at least one delinquent payment or more. The middle is mortgages that are delinquent 60 days or more, and the ones on the right had already gone bankrupt or foreclosed. You can see very quickly that things were starting to get worse. There were a lot of mortgages that were already starting to become late or delinquent, and considering that these mortgages were only a year old, they had a lot of room to get a lot worse. Now, when all the banks were telling themselves that it's not going to be that big of a deal if a lendee defaults on a mortgage, they would just sell the house. Well, here's what happened. In early 2006, those banks were showing about 10 to 15% losses from offloading the repossessed houses. But with the market slowing down, by September, they were now showing about 30 to 45% losses. Keep in mind that these were mortgages that were packaged and sold as securities. These were supposedly safe investments, and the people buying these were depending on this money to still exist. It was money that they didn't expect or could afford to lose. So we all pretty much know what happened after this point. The housing market did collapse. The banks who were heavily involved in these mortgage-backed securities took it on the chin. Lehman Brothers failed, and the government had to bail out the economy to prevent even further collapse. For Burry, after 2008, he ended up closing out his hedge fund, but he didn't take his money and go live on some island with a Fruit Loops bird. Instead, if you paid very close attention to the end of the movie, Burry said he wanted to short water. Water is obviously very important. Civilizations obviously needed to function, and as we're seeing with these global weather pattern changes, kind of like what's going on at Lake Mead right now, water access can be incredibly valuable. You can't easily transport water, so some areas just might be doomed, but at the same time, you also can't short water directly. So Burry realized he needed to be a little creative to figure out how he was going to short water. So he ended up going and buying farmland, specifically farmland that had very strong and very reliable access to water, with the theory that as freshwater access becomes more and more difficult, farmland with strong and substantial access is going to skyrocket in value. But it's not exactly clear how this turned out for Burry and all of his farmland purchases. What we do know is that by 2019, when asked about his big water short, he said that he sold out all of his farmland and gold assets a few years ago and was moving back to focusing on individual stock picking. So by 2015, Burry had turned his focus back to the Federal Reserve again. He believed that the Reserve was completely out of control and was headed for a 100-year flood event. To stimulate growth coming out of the 2008 recession, the Federal Reserve had dropped interest rates to extremely low rates, and the federal government had given out a ton of money through stimulus packages to various institutions. But Burry believed that this hadn't worked and was expecting low economic growth going forward. He seemed to believe that the world was addicted to easy cash, that we were going to have to go to negative interest rates, which is a chaotic and toxic environment, and any small stresses on the system could crush outlook. He saw the federal debt as a big concern, that the leverage of the Federal Reserve's balance sheet was 77 to 1, and that the absurdity befuddled him. He thought that in the post-subprime world, that after seeing all this reckless spending and loaning of cash, that we would enter into the era of personal responsibility. But interest rates near zero broke the social contract for generations of hardworking Americans who saved for retirement only to find out that their savings were not nearly enough. You no longer could use bonds or other ultra-safe investments as a source of income in retirement, and instead you were forced into the stock market, which is again much riskier. Which then brings us to Burry's next big prediction in 2019. So because safe investments like bonds or treasuries weren't really enough to be worthwhile anymore, it pushed a lot of people again to invest in stocks. But because individual stock picking is one, difficult, and two, much riskier, it pushed people to start buying up index funds. But Burry predicted a big issue with the strategy. He thought that this would cause two problems. The first is it kept small companies from being able to have easy access to cash. These big index funds like the S&P 500, probably the biggest of all of them, only involve the largest 500 companies. So if you were outside of these 500 companies, there was a big drop off in interest for investments. The second, and probably more consequential, is all of this demand for these index funds, especially of these large cap companies, was bidding up the price of all of these large cap stocks, creating what he was calling the passive income bubble. And the big reliance on these much safer stock investments, the bursting of the passive income bubble would have severe consequences. Now, Burry did make this prediction in 2019, so I guess you could say there hasn't been enough time to prove if this was accurate or not. But since August of 2019, the stock market has seen one very serious crash and then another very substantial and sustained bear market, which makes me feel like these index funds have been pretty well tested, especially since his projection was made. And looking at the biggest of them all, the S&P 500, the index is actually still up about 40%, not including dividend payments. And considering the S&P 500 is sitting at a price to earnings ratio of 21, which is a very average number for that index, I would say that Burry is wrong about this prediction. Maybe it's too early, but it does not seem to be playing out. Now, I think this is where things start to get pretty interesting for Burry. From 2019 going on, I would say that while Burry's predictions might seem a little wild at times, they do seem to get significantly more accurate at this point. So before everybody heard about GameStop in January 2021 during the big short squeeze and GameStop mania, Michael Burry was actually way ahead of Wall Street bets, which is not that surprising though. He actually looked at GameStop back in 2019 and thought it was an incredible value stock. And he thought so much of it that he bought 3 million shares worth $16.5 million at the time, which would give him an average cost of $5.52, which if you adjust for the recent split, in today's dollars would be about $1.38. Burry thought that the market was way too pessimistic about GameStop. He thought that concerns over how the company would compete as games moved from discs to digital downloads were overblown because the consoles still had optical drives, which meant that consoles would still be able to play video games on the physical discs purchased from the brick and mortar locations, and that the streaming narrative was just making things look worse than they actually were. At the time, the company was cash flow positive, and Burry thought that they could issue buybacks as an effective way to use their cash. Now, flashing forward to January of 21, when GameStop went completely lunar, Wall Street bets went nuts about Burry's bet. The top comment in a post about how Burry made 1,500% on the 1.7 million shares he was still holding, that this guy's hands are made of diamonds. Everyone laughed at him when he went all in on GameStop. But there was one guy who probably wasn't laughing, and no, it wasn't Ken Griffin, the CEO of Citadel, or Vlad from Robinhood. It was Michael Burry. See, when Bloomberg reached out to Michael Burry about his GameStop shares, Michael Burry replied via email that he wasn't long or short on GameStop anymore, and we found out when the fourth quarter filing came out for all of his holdings, meaning all of his shares at the end of December of 2020. It turns out that Burry had actually dumped all of his stock the month before the GameStop launch. So while Burry didn't make the 1,500% return that Wall Street bets thought, he did do extremely well for himself, earning somewhere between double to quadruple his initial investment. Now, going back a little bit to the beginning of 2020 and that big event that I'm not going to mention so the YouTube algorithm doesn't shadow ban me, Michael Burry, who also came from the medical field, he actually has his MD, he actually has a pretty unique perspective that probably a lot of us don't have. But just focusing on the economics and the financial side of things, Burry said that if there was ever a time for the government to stimulate the economy, it's now. But they've been adding $3 of debt for every $1 of new GDP for a long time, and interest rates were already near zero. Nothing was more important now than loans to small and mid-sized businesses, and treasury notes backed by the Fed is providing vital liquidity. What he's basically saying is that the Fed going into this crisis already had their foot so hard on the gas that he didn't think that there was much more room for them to be able to give. And he had a lot of concerns about whether or not the federal government was going to be able to absorb all of the extra debt that they were going to have to take on. Now, he did also mention inflation at this point, and this is going all the way back to the beginning of 2020, so this is very early in the process for somebody to mention this. But his reasoning for it wasn't because of what the Fed would eventually do, which is double the money supply. Instead, Burry believed that inflation was coming because countries would recognize the supply chain disruption issues caused by global trade. He believed that countries would look to bring back supply chains home, and that many employees would need retraining at higher costs. So he was expecting that companies would go back to much more of an isolationist approach. And because, for example, it's much more expensive to build a factory and pay a worker in the United States than it is in China, Vietnam, or India, that this would cause inflation. Now, we are going to pause talking about his inflation prediction right now. We're going to come back to it later in this video, but I want to try to keep this thing in a little bit of chronological order. So by late 2020, we saw two giants of the meme stonk economy face off: Michael Burry versus Elon Musk. Burry had revealed a huge bet against one of retail's favorite stocks, Tesla, with $534 million worth of puts, a massive 40% of Michael Burry's portfolio placed against Tesla. He believed that Tesla's reliance on regulatory credits to generate profit, thin margins, and a massive market cap raised a lot of concerns. He even publicly taunted Elon to issue more shares while they sat at such ridiculous levels, as he says. But Burry wouldn't stick with this bet too long, and actually by the third quarter of 2021, Burry had closed all of his puts. Or they expired. I have no idea which, because we don't get any information about what the puts actually are. But he didn't buy new puts, which means that he did kind of exit the position. And looking at if he made money or not from these puts, considering that Tesla's stock chart didn't really drop during that time span, my guess, depending again on when exactly he bought and when exactly he sold, is that he probably did not make money off of these, but it's impossible to actually tell for sure. So moving forward to 21, we got some comments from Michael Burry indicating that he's not a crypto guy. And he's especially not a crypto guy when Bitcoin's trading at $60,000 a coin. And in a Twitter thread, he openly talked about shorting it from these highs, which in hindsight would have been the perfect time to short Bitcoin because it's fallen about 70% since that day. However, he did finish his tweet by saying, "I tend to think it's not best to short it," but he was thinking out loud here. He said that he thought crypto was in a bubble in October of 21, and he went on to call shibcoin completely pointless. Okay, so remember how I said to remember about inflation because we're going to talk about it later? Well, here we are. In February of 21, pretty far in advance of anybody mentioning inflation seriously, Michael Burry started talking about it again. He highlighted what Warren Buffett said in his 1980 letter to shareholders, that rates of high inflation act as a tax on capital, discouraging companies from investing by reducing their real returns. He pointed out Buffett's comparison that it's like a person trying to walk up a down escalator, only that escalator is starting to be turned up so high that the person's starting to move backwards. He believed that as the US started to reopen and was again receiving another round of fresh stimulus, that we were headed to the hyperinflation that Germany saw in the 1920s. In one of what I think has been his sharpest moves since his housing crisis prediction, Burry went on to buy puts on 20-year Treasury index funds. He believed that at this point interest rates had to rise. And for anybody who doesn't get why he'd buy puts on these treasuries, basically because interest rates were going up, this would mean that the yields for bonds also have to go up. And for bond yields to increase, the principal of those bonds have to drop. So while inflation didn't get much mention until about the summer of 21, which is about 3 months after Michael Burry had already been warning that we were headed on the same course as 1920s Germany in terms of inflation, very important distinction. Burry said that the markets were facing the greatest speculative bubble of all time in all things by 2 orders of magnitude. And by late September, Burry tweeted out that the stock market reminded him of the dot-com bubble, tweeting out a picture showing financialweb.com's stock chart. It showed the stock going from all-time highs at 28 per share to just a fraction of a few cents. And at the time, this was a pretty common thing to see following the crash. Now, just a couple months later, in November of 21, when Jerome Powell had finally come out and said that, yeah, inflation isn't transitory, it was a mistake to use that term, Burry had made some pretty serious moves. He reduced the positions in his portfolio from 22 to just 6, with CVS, Lockheed Martin, and Geo Group, which is a private prison company if you haven't heard of them, making up about 90% of his open holdings. And then by the second quarter, Burry went on even further to sell everything except Geo Group. But because we get this information from a 13F filing, we don't really know what he's done between these reporting dates. For all we know, the day that he had to file, he sold everything the day before, and then immediately after he bought a whole bunch of stock. Now, I doubt that this is what happened, but I'm just saying to take his moves with a little bit of a grain of salt. Now, as the 22 bear market really started to get deep, around the bottom in June, or at least the bottom that we've seen so far, Burry warned about the bullwhip effect. He believed that the Fed might pause or even reverse interest rate hikes. His thinking was as retailers had to purchase inventory at inflated prices, they would pass some of that higher cost on to consumers. But as demand starts to slow, at some point retailers will have paid too much and they're going to have to sell all that inventory at prices less than they anticipated. But I don't really think that this is too likely, especially after what Jerome Powell said at Jackson Hole just a month ago in September, that he was way more interested in being aggressive with interest rate hikes early on rather than trying to drag any of this out. Now, we have seen a pretty decent rally in the stock market from June until September when I'm recording this video, but Burry says that he doesn't think we're out of the woods yet. While inflation certainly has been pretty hard on a lot of consumers, Burry doesn't think that it's impacted earnings yet. Now, a year before all of this, he said that we were headed for the mother of all crashes, and so far we've seen about a 20% decline decline in the stock market, certainly far off from the mother of all crashes. But Burry says that we haven't hit the bottom yet, that we have to wait for failures and then look for the bottom. 2 SPAC ETFs failing is not near enough, and then in a follow-up tweet, crypto meme SPAC crash, check. Inflation, check. 2000, 2008, 2022, check, check, check. Now, I don't exactly know what the crypto crash was in 2000 and 2008, but I understand what he means here. His point is that all of these very speculative investments have crashed at this point, and he believes that somehow all of this means that we're headed to an even further decline. I guess, honestly, it's kind of a vague tweet, so it's a little hard to tell exactly what he means by it, which is kind of annoying. So Michael Burry, if by some miracle you see this YouTube video and you can further elaborate to explain what you actually mean, please tell us. We'd all love to read the tweet. But I do think that Burry's expectations for economic pain, at least over the next 6 months, do make a lot of sense. Inflation projections aren't supposed to be under 3% until the fourth quarter of 2023. So just because we've started to see inflation come back down, that does not mean that we're out of the woods yet and everything's going back to normal right away. We are probably still going to see interest rate hikes over the next year, but it's hard to tell by how much exactly. As consumer demand starts to slow with these interest rate hikes, we probably are going to see unemployment tick up. And I do think that Michael Burry's bullwhip effect that he's talking about, businesses basically trying to catch up with inflation coming back down, although I think that would really be more deflation rather than a reduction of inflation. I think it's still a pretty interesting concept that we have to consider. If Michael Burry's prediction of the mother of all stock crashes actually does happen, my expectation is that inflation ended up being far more resilient than anybody is projecting at this point, that the Federal Reserve had to go full Paul Volcker to get inflation under control, causing a lot more economic pain than we're seeing today. But I'm just hesitant to think that we're on that path at this point at least. So how accurate have Michael Burry's predictions been over the past 17 years? Well, he obviously nailed the housing market crash, but then things got a little wonky for a few years. Shorting water and saying that the government didn't really have the ability to stimulate the economy if it really had to. I don't really think that that turned out correct. But I do actually think since 2019, he has been pretty sharp with a lot of his forecasts. Maybe at times a little hyperbolic, and he certainly isn't perfect, but who honestly is perfect at predicting the stock market? I will say that going into this, I was a little skeptical of Michael Burry. I had thought that he nailed 2008, but I thought he seemed a little too lunatic-like for me after that. But after doing all of this research and reading all about him, I actually think a lot more highly of him at this point. You have to consider what he says through the Burry lens. Michael Burry is certainly an independent thinker who really does not care what anybody else has to say about anything. I think he's really good at seeing some of the underlying issues with the economy and what could go wrong, but he does also have his wild idea piles. What I have noticed especially is when he is wrong, he tends to back off of those predictions fairly quickly. So what I would recommend is to pay attention to what actual moves he makes after he makes a big statement. So that's the video, and as always, thanks for watching.